Hi guys, this is McRae and welcome. This week we're going to talk about financial ratios, and I shall cover a few of the financial ratios which I consider to be important. Business is all about numbers, and it's important as you go through your journey as an entrepreneur and business owner that you become financially literate. I've always wished I had known more about accounting in the early days because it's such an important part of your business. And as your business grows, you'll be looking more and more towards the financial numbers that you see. You'll be having conversations with accountants. You might be involved in mergers or acquisitions, and they all revolve around numbers. So what I want to try and do this week is just discuss a few of the important financial numbers that you should know. So let's have a look at a few. So the first one we'll look at is the current ratio. So the current ratio shows how well a company's current assets can cover its current debts that are due within a year. When the ratio is written as a number, it shows how many times current assets can cover current liabilities. So basically what it means is that if you added up all of your assets and you added up all of your liabilities, how many times more does your assets cover your liabilities? You should always be in a position where your assets are more than your liabilities. And it's usually measured in a year, but obviously you can measure it in any amount of time that you like. Then we've got quick asset ratio. So the quick asset ratio is similar to the current ratio, but it doesn't count inventory as a current asset because it's possible that the inventory can't be turned into cash quickly. And that's very true. So if you had to, you might have $1 million worth of stock, you can't turn that into cash quickly. So the quick asset ratio does the same thing. So it's liquid assets divided by the current liabilities that you have. Then we have the cash ratio. Now the cash ratio is the one that I pay the most attention to. So if you were building a dashboard, it's important that you would have some idea of the cash ratio. And you can think about this like a house. How much money do you have in the bank? And how much expenses do you have? How many months could you live without an income? So the cash ratio assesses a company's capacity to meet its short-term obligations using solely its most liquid assets, such as cash and cash equivalents. It is computed by dividing cash and cash equivalents by current liabilities. So this is a number that I do use a lot, particularly with online businesses, because cash and cash equivalent is, and I think of it in terms of a month. So if someone were to switch the lights off, if all income were to stop, how much cash could I get my hands on in 30 days? And how does that compare to how much liabilities I have? So if you divide them both, that gives you an idea of, for example, if I was measuring it in terms of a month, if the ratio was 5, I know I could go 5 months without having any income to that business. And that became very important during COVID for some businesses because they needed to know how much cash they had before, so that they could make decisions about the staff, about whether they should continue, whether they should lock up the business. So that cash ratio of the liquidity ratios that I look at is the most important. And I recommend you have that on your dashboard. So if you want to see more of this type of information, you can get me on YouTube's the best place. Just look for Mark McRae on YouTube. Thanks for listening, guys, and don't forget to give a like and a follow if you like the information.